Sigma Healthcare's share price rose 4.5% today. That number matters because today was the day the Reserve Bank of Australia raised interest rates for the third consecutive meeting, returning the cash rate to 4.35%, the exact level it sat at before the RBA's brief easing cycle began. Every cut delivered through 2025 has now been reversed in 3 months. The broader ASX 200 finished lower, down around 0.5%, extending what has become a 7-session slide. The S&P ASX 200 futures had already pointed to the decline before the open, with the Dow Jones falling over 1% overnight as U.S. and Iranian forces exchanged fire in the Strait of Hormuz. Brent crude ripped to a 4-year high at US $114 a barrel on missile strikes near the Fujairah oil terminal. Energy stocks were the session's bright spot, up 1.3%, while miners and the big banks took heavy losses. The RBA's statement left little doubt about the direction of travel. Inflation, which has climbed back to 4.6% annually, was driven higher by the conflict in the Middle East, which the board said may slow growth in Australia's major trading partners and domestically. The central bank acknowledged it could not look through the oil shock. The same statement warned of early signs that firms experiencing cost pressures are looking to increase prices. Within hours of the decision, Commonwealth Bank announced it would pass the hike on in full to variable mortgage holders. The other major banks followed. Westpac had already reported its half-year numbers before the RBA moved. Statutory net profit for the 6 months to March was $3.4 billion, up 3% year-over-year but down 5% from the prior half. NAB's first-half profit rose 2% to $3.6 billion. Solid loan growth, marginally better margins. Yet Morningstar's note read, solid result but valuation is stretched. Investors were disappointed. Return on equity for Westpac came in at 9.6%. The banks are growing, but the market is asking whether this is the ceiling before higher-for-longer rates compress margins and credit quality deteriorates. That was the consensus session. Rates up, consumer sentiment down, banks grinding but not exciting, energy the only sector with wind behind it. And then Sigma reported its Chemist warehouse numbers.
Chemist Warehouse is not supposed to thrive when borrowers are losing ground every quarter. The chain's customers are the same Australians absorbing fuel price spikes, 3 rate hikes in 3 months, and wage pressure from a government budget that the AFR noted has inflation as its central challenge. Consumer confidence surveys point to belt tightening, yet Sigma Healthcare's update, released ahead of the Macquarie Australia conference, showed like-for-like sales across the Australian Chemist Warehouse network up 14.4% for the financial year to date through April 30. Total branded store sales rose 16.7%. The mechanism is not straightforward. Chemist Warehouse does not sit cleanly in the defensive staples category. It sells cosmetics, vitamins, weight loss medication, and premium health products alongside prescriptions. The intuitive read in a high-rate environment is that discretionary health spending gets cut first, but the data runs in the opposite direction. 2 forces explain this. The first is GLP-1. Sigma's management specifically noted that the numbers were achieved while cycling the GLP-1 uplift from the second half of 2025, meaning the base period already included a wave of demand from anti-obesity medication. Growing through a tough comparison of that magnitude changes the interpretation. These are not soft numbers buoyed by a one-off pharmaceutical trend. The underlying business is accelerating without it. The second force is the structure of healthcare spending on inflation. When living costs rise, Australians tend to defer discretionary spending, but not health-related purchases they experience as necessary, particularly as the population ages and the Medicare rebate gap widens. Chemist Warehouse has positioned itself at the intersection of pharmacy necessity and accessible health retail, which insulates it more than the share price typically reflects. International numbers add a layer. CW's global store network, covering New Zealand, Ireland, Dubai, and online in China, grew 11.8% for the 9 months to March. The company is now expanding into the UK market, a move management flagged at the conference. Sigma shares climbed 4.5% as the session absorbed the data. On a day when the ASX 200 could not find direction, a pharmacy chain was the clearest winner. But the reversal insert sits right here. The same RBA that drove Sigma share price higher today is also the mechanism that could unwind it. If rate hikes are working, if consumer spending begins to compress meaningfully in the second half of 2026, GLP-1 demand stabilizes, discretionary health purchases contract, and the 14.4% LFL rate reverts toward the system average. The question is not whether Chemist Warehouse is strong. It is whether the conditions generating that strength survive the next 2 RBA meetings.
Australia has been here before. During the 2022-2023 tightening cycle, the RBA raised rates 13 consecutive times before pausing. Consumer discretionary shares fell sharply and stayed lower. Healthcare stocks, including pharmacy-adjacent names, outperformed for the first 6 to 8 months of that cycle before tightening finally broke through to out-of-pocket health spending. The current cycle has now delivered 3 consecutive hikes. If the 2022-2023 pattern holds, the RBA's medicine has not yet fully circulated through household balance sheets. The AFR noted that Australia retains monetary and fiscal policy room to respond to a slowdown, a view Macquarie Group CEO Shamara Wickramanayake advanced at the conference, calling the doom framing excessive. That is the constructive read. The alternative read, reflected in the ASX's 7-session decline, is that the market is ahead of the fundamentals, pricing in a credit quality deterioration that Westpac's 9.6% ROE and NAB's 2% profit growth have not yet delivered. For Sigma and Chemist Warehouse, the verification benchmark is simple. Same-store sales for the June quarter will tell whether the 14.4% LFL rate is a trend or a trailing artifact of GLP-1 cycling. If it holds above 10% through a period of genuine consumer stress, the defensive health thesis is confirmed, and the UK expansion becomes a structural growth story rather than an opportunistic one. If June quarter LFL compresses towards 6 to 8%, the session's 4.5% share price gain looks premature. The evidence today tilts towards the thesis holding. The base effect argument is credible, and healthcare spending historically lags consumer sentiment by 2 to 3 quarters in tightening cycles. But the RBA has not finished. Governor Bullock's hawkish 8-1 vote signals that another move is not off the table. The cash rate is now back at 4.35%. The question the June quarter will answer is whether Chemist Warehouse found a genuine floor in Australian consumer spending, or whether today's numbers were the last strong reading before the hikes finally arrive at the pharmacy counter. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.